The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box this Thursday morning, a morning where political consternation tops the agenda, and that's why we're joined with Charlotte Reid in Paris and Sherry Kang in Seoul. And these are your headlines.
France in turmoil as a vote of no confidence brings the government down, making Michel Barnier the shortest-serving Prime Minister in over 60 years.
Il n'y avait pas d'autre solution.
There was no other solution than this one. Once again, I regret this. Monsieur Barnier, all he had to do was agree to not de-index pensions from inflation, not to take it out on pensioners, for this situation not to exist.
South Korean President Yoon Suk Yeol prepares to face an impeachment vote this Saturday amid anger over his martial law declaration.
In the markets, technology stocks. Take a look at that. The Nasdaq up 1.3%. Well, fueling majors to fresh records as the Nasdaq sees its best day, actually, since July. But the Fed Chair Jerome Powell dampens rate cut expectations, speaking at the New York Times Deal Book Summit.
The economy is strong, and it's stronger than we thought it was going to be in September. The good news is that we can afford to be a little more cautious as we try to find neutral.
And it finally got there. Bitcoin topping $100,000 for the first time, accelerating a blistering post-election rally as the president-elect Donald Trump taps the crypto advocate Paul Atkins to chair the SEC. The French government has collapsed after the Prime Minister Michel Barnier and his cabinet members were ousted in a no-confidence vote. The French far right joined forces with the left wing of policymakers to bring down the government. The first time it has collapsed in this way since 1962. Well, we've talked a lot about French yields and the expansion over bunds, but for my mind, these are not dramatic moves. We keep hearing that there are comparisons with Greece, or not comparisons with Greece if you're in the French government as well. Well, at the moment, it is a very tempered reaction on French yields. Look at this, 2.89% for 10-year paper, regardless of the spread over German paper, is not dramatic, ladies and gentlemen. You know it, and I know it. Let's take a look at the euro again. Again, multitude of problems for the euro, but again, I would suggest to you the reaction on the euro dollar is incredibly calm. In fact, if anything, the euro is picking up 0.2 of 1%. In fact, if anything, when I look at the CAC 40, it is actually up for the week. So whilst we are very cognizant of the pressure being put on French assets, whether it be government bonds, whether it be the currency more generally, or whether it be French stocks, the fact is in this week of stunning turmoil, we have not seen stunning turmoil on assets. Right, just want to get that one out there because a lot of you are trying to write these headlines, I noticed, from people who don't know much about bond markets, saying about the extreme moves. Well, they're not extreme moves. French President Emmanuel Macron, who must now appoint a new Prime Minister, is set to address the nation in a televised speech tonight. And Charlotte joins us live from Paris. And whilst I say the moves on asset classes, on French focus products are not dramatic, the moves in Parliament are dramatic. And it will go down in history as a Trivial Pursuit game. Name me the 4 Prime Ministers of France in 2024. Well, we need to name the next one for a start.
No, it isn't. That's why it is historic in a way, because only ever once since 1958, so in the Fifth Republic, has the Prime Minister been toppled by Parliament. And again, Michel Barnier, the shortest serving Prime Minister since 1958, just 90 days. And it's just a very unknown situation, as you were saying, 4 Prime Ministers in just 2024. And it's getting shorter and shorter. Elisabeth Borne, that's at the year, she stayed 18 months in the job. Gabriel Attal, just 6 months in the job, cut short by the snap election. And now Michel Barnier Barnier 90 days. The question is, can the fourth Prime Minister of this year last even longer than that? And that really is the question now. And the man that's been out of the picture during all this political turmoil, of course, is the President Emmanuel Macron. He has been carrying on with his presidential duties, a long planned state visit to Saudi Arabia that he just came back for yesterday. And so now he's taking back center stage. He has to pick a Prime Minister. And this time he won't take 2 months like he did with Michel Barnier. He wants things to go much quicker. Some say it could even happen today. And of course, you know, like over the weekend, you have the reopening of Notre Dame, a lot of dignitaries coming for this, including President-elect Donald Trump. And it would be strange scenes to have all these celebrations happening while the political instability and turmoil is going on. So they expect him to have named a Prime Minister by then. So he's addressing the nation later today, again, to kind of give an image of stability and continuity of the country, maybe give the vision of what the rest of his mandate might look like. And we have to wait and see who he picks, but that would be a tricky job because, again, the parliament remains as fragmented as it is now, 3 blocks that don't agree on very much, and it will remain the same until at least July next year. So what kind of Prime Minister might be able to work and make some compromise and take some measures to tackle the deficit in particular with the different groups? That seems a very difficult equation. Some names have started to circulate, including Sébastien Lecornu, the current defense minister, but he's a close ally of Macron. So maybe that is not the kind of figure that they want. The left want their Prime Minister to come from their side. The far right want the Prime Minister to come from their side. And that is a difficulty now. But again, we know that the instrumental person in the Prime Minister falling has been the far right leader, Marine Le Pen. She's the one that supported this vote of no confidence that was tabled by the left. So a very unusual alliance between the left and the far right to make this happen. And speaking on television last night, she explained why she decided to support this vote of no confidence.
On censure le gouvernement.
We censor the government and threw it the budget to protect French people. There was no other solution, and again, I regret it. Monsieur Barnier could have just decided to index pensions on inflation, to not hit pensioners for this situation to not happen.
Now, the far left, yesterday after tabling this vote of no confidence that became successful, now they're calling for Emmanuel Macron to step down. So here again, the Constitution doesn't require him to do that at all. He just has to pick a new Prime Minister. There's no election here until 2027. But for the far left, what they're saying is that, look, given the instability here, there's no government that can stay in place for a long time unless it comes from their camp, of course. That's what they say. Then the only solution is for the president to step down and call a new presidential election. Now, you can argue that would just add more uncertainty because that doesn't change the situation in Parliament. Parliament remains the same until July. So calling on top of that a presidential election would just add more uncertainty and more confusion, more instability. But that's what the far left is asking for. And here again, going back to Marine Le Pen, asked whether she was supporting for Emmanuel Macron to step down. This is what she said.
I'm not calling for Emmanuel Macron to resign. I'm saying that there will come a time when, if we don't take the path of respect for the voters, and respect for the political forces, and respect for the elections, well then, the pressure on the president will obviously get more intense. But he alone will have the decision, the last word.
So again, we have to wait and see whether Emmanuel Macron picks his Prime Minister quick, who that can be, and can that person work with the different political groups here, or is that person going to be toppled straight away by another vote of no confidence? We'll have to wait and see. But here again, an interesting Christmas coming up for French politics, and potentially things might be difficult in 2025 because, again, in the background, the deficit ballooning above 6% this year, and who might be able to take some measures to try and tackle this is going to be difficult.
Just very briefly, Charlotte, because we've got a great guest waiting in the wings. Who in their right mind would want to be Prime Minister now? You had Barnier, who had presidential ambitions. They soon got snuffed out before the last election as well. Who in their right mind, who is an aspiring politician, will take this most poisoned of chalices?
And that is a good question. Apparently, again, for when he nominated Michel Barnier, who was towards the end of his career, was a good way to end his career, and kind of didn't have much to lose, and that's why he accepted the job. Apparently, other people have been approached and actually didn't want to take the job. So it might be even more difficult this time around to find someone that wants to step to the plate. So we have to wait and see. A couple of names, again, that circulated are close allies of Emmanuel Macron, Sébastien Lecornu, the defense minister, or François Bayrou, Bayrou, who's the leader of the Modem, one of the parties in Macron's coalition. But very difficult to see who might want to take that job. As you said, a lot of people want to take that job from the left-wing bloc. Maybe Marine Le Pen certainly might want to take that job. But that doesn't mean that they can get any sort of majority, any sort of stability themselves. They will probably be toppled by the rest of Parliament as well. So that is a very, very difficult decision here.
Okay, and the one for our viewers who are just trying to work out the fourth one, it's Elizabeth Bourne who was the first one, if anyone can't remember. Then it was Gabriel Attal, then Michel Barnier, and goodness knows who the fourth one will be for our quiz question. Thank you very much indeed for that, Charlotte. George Lagarias is chief economist for Vis Mazars. And actually, while Charlotte was talking, as well as us listening to Charlotte, we were comparing Greece and France, because actually George and I have got something very much in common. We were both in central Athens at the time of peak crisis in 2010 for the Greek government. We remember what Greece was going through and the tragic time for many savers and people just queuing outside those ATMs. You were there when that bank was firebombed. I was actually in Sigtagma. So it's extraordinary events. Let's just tell our viewers something, especially the more extreme of you out there, and maybe the Daily Telegraph writers or whoever you are. This is not Greece 2010 that we're seeing at the moment, is it?
No, France is not insolvent to begin with, A. And B, big countries, G7 countries, they don't get debt crisis in the 20th century, in the 21st century. Okay, this is the purview of smaller countries. Greece was insolvent way before any of that happened. Okay, France is going through something, it's political tumult. Yes, there is some worries in the bond markets. There were worries in the bond markets.
Many worries.
Exactly.
I presume I've been there. I've kind of seen the tragedy of the Irish bonds bursting, the Greek bonds bursting. The yields were extraordinary. They were broke, the governments, in many ways. This is 2.8. Get the French 10-year up if you can, please, team. At 2.89%, you can raise a lot of money and still survive as a government.
Yes. So it's political tumult. It will likely last for a long time. It highlights whatever worries in the bond markets. They do highlight the structural issues in the Eurozone, to be sure. Okay, but ultimately, A, this is not Greece, and B, this time around, the ECB, headed by a French person, is also very potent.
Yeah. Was that, did you say a French person? You say this person was another one of those French finance ministers, and I remember chatting to Madame Lagarde. I think I was in Oslo or Helsinki I was in. Before she was she was the French finance minister. I remember chatting to her there. And she is another French finance minister who has failed to balance the books in the last 50 years. So this has been a very slow burning fuse, hasn't it, George?
Yes, look, France is not one of the most, it's not Germany running primary surpluses.
Everyone can run a primary surplus. It's not
well,
good if everyone runs a primary surplus.
Greece has been running primary surplus for some time now.
And they've done very well, but unfortunately they've still got a vast pile of debt, George.
Yes. Only around 180% of
Just
GDP, but who's
counting?
counting?
Don't worry about that.
But the point is that, yes, there might be some worries and there might be some jitters in the bond markets because bond markets are really upset about inflation and tariffs and all that. So, some of that could seep into the bond markets going forward, some of that uncertainty. But France is not Greece.
Yeah, and we've established that, and we've been very clear-headed. I've been perhaps more hot-headed about it, but it is not. Having said that, you've just hit the nail on the head with part of the problem. The rules are that you don't have 180% debt to GDP. In fact, you don't have anywhere near 100% debt to GDP. You don't run 6% deficits. So the Greeks and the Italians and the French and everyone else who either has A, debt to GDP significantly north of 100%, or B, has a deficit in your budget spending of significantly north of 3%. You are relying on those bond markets not to get jitters. You are relying on the ECB to come up with its TPI or whatever latest acronym they've got to protect them at some stage, to provide some form of Draghi put or Lagarde put as well. That's a dangerous strategy to do ad infinitum.
Well, it is, but Eurozone countries, unlike any other countries, they cannot print their way out of trouble at a whim, right? Because the ECB has to get together.
They had to borrow their way out of trouble, George.
Sorry?
They don't seem to be able to borrow their way out of trouble either.
No, well, much easier than in the past. We have to acknowledge it's not the Eurozone crisis. They can borrow their way out of trouble, just not at the pace that they're used to. Look, we have debt acceleration, and that happens everywhere in the world right now. The US is the primary culprit.
Yes, it does. And I'll get to the primary culprit when we chat later on, but I will do a compare and contrast first. Carry on.
Okay, so the US is the primary culprit. Yes, France has what? It has nearly double the interest payments that it gets in GDP growth, so that's not sustainable. And unlike the US, it cannot print its way out of trouble because it does not control its own central bank. Okay, so yes, there is a problem there, and that's why bond markets are focusing on that, and not on the US, who is a lot more profligate. But ultimately, the ECB will do whatever it takes.
George, I have a childlike understanding of economics. There we go, which takes me down to the lowest common denominator. In the United States, vast deficit plus huge amount of borrowing money, which we'll come to in more detail later on, equals growth. I'm being very primary here. I'm painting a very simple picture on my Nobo board. Other boards are available. So US deficit spending plus vast amounts of issuance seems to be equaling growth. I think that's fair to say that the Biden administration and incoming Trump administration, they seem to have a bit of growth. Why is it that vast deficits plus issuance in Europe does not equal growth?
Because the euro is not the dollar, and the US is printing the global reserve currency, which is tantamount to gold.
Oh, come on, George. Is it really just about the currency? Is it really about the issuance there? Or is it actually about something structurally really wrong in the state of Denmark?
Well,
I use Denmark, but I was talking more Hamlet, by the way.
First of all, obviously, there is an unfinished banking union. And as I said, the euro is not the dollar. That's where it all ends up. The euro is not as structurally sound as the dollar. It's not backed by the same type of force. But ultimately, even with all the issuance, emerging markets, when they go down, they still want dollars and not euros. And that's a very powerful weapon. In the modern day,
and Trump's not going to want them to use anything other than the dollar either. He's already made the threat, hasn't he?
He's been very open about that.
Yeah.
So, in modern day times, the nuclear weapon of choice is not a nuclear warhead, it's the currency.
Yeah.
Okay, and the US has the global reserve currency that allows them to run high deficits and pay for growth and get it from the rest of the world.
Yeah, I've just been doing some reading about the height of the Cold War. I'd rather you didn't use the nuclear term.
Fair enough.
Well, I think we both grew up in a terrifying period called the 70s and 80s. Well, I did anyway. George, you're probably a lot younger than me. You'll come back to us because we want to talk about the other side of the coin as well, which is the dollar and the United States and the incoming administration. George Lagarius, Chief Economist at Forvis Mazars, thank you very much indeed for now. Right, coming up on the show, Fed Chair Jerome Powell hails, there you go, the strength of the US economy. We'll bring you his comments next. South Korea prepares to vote on impeaching the president amid the backlash over Yoon Suk Yeol's decision to impose martial law. And we'll be speaking to the Appian CEO, Matt Calkins, to discuss all things Trump and AI. That's at 6:30 London time. I don't know what she's been doing for 20 minutes, but it's nice to see her. Sorry, you're waiting for me to shut up, I know that. Tell us about the markets.
Indeed, let me get you up to speed with what has happened on Wall Street over the last 24 hours. Starting looking at the U.S. equity market. Another strong day for U.S. equities. It seems that this bullishness on Wall Street just seems to keep going. Yesterday, we saw the Dow, the S&P, and the Nasdaq, the three indices hitting fresh record highs. This as investors were digesting numbers from Salesforce, but perhaps more important, comments from Jerome Powell. Speaking of Jerome Powell, let me show you how bond markets have also been faring. This as indeed Jerome Powell suggested that the U.S. economy is still very strong. At this stage, the commentary from Fed officials seems a little bit vague, really, about what they're planning to do. At this stage, there's a 72% chance that we'll see a 25 basis point cut next next week, but let's see. Yesterday, though, we did see yields falling a little bit during Tuesday's session. Looking at just at the benchmark, the yield on the 10-year Treasury at this stage moving a little bit higher at 4.19. In terms of what has happened in the FX space, these are some of the moves for dollar crosses. We are keeping a close eye on what is happening in terms of dollar and the Japanese yen. This because we are seeing a readjustment here in terms of expectations, in terms of what the Bank of Japan is going to do later this month as well, with investors at this stage questioning whether we're going to get a hike. And in terms of what we have been seeing in the Asian bourses this morning, these are some of the moves. We have the Nikkei 225 at this stage in the green, up 0.2%. However, looking at the other bourses, I just want to make a final point looking at the Kospi. We have seen the levels there, Steve, getting a little bit more steadier today now that we have a little bit more clarity about how this process might unfold. But still, the main market down about 0.9%.
Oh, it was worth waiting for. Thank you very much indeed for that. As Sylvia mentioned, private payrolls grew 146,000 in November. This is according to data from ADP, down from October's level and below expectations. But wage growth was reported at 4.8%, the first acceleration in more than 2 years, i.e., people are getting 4.8%, but their inflation rate is lower. Ergo, their real standard of living is improving. Ergo, we had the best Cyber Week and Cyber Monday sales that we've seen ever. Anyway, Fed Chair Jerome Powell sat down with CNBC's Andrew Ross Sorkin at this year's Dealbook Summit and weighed in on the recent economic data.
The economy is strong, and it's stronger than we thought it was going to be in September. So the labor market is better, and the downside risks appear to be less in the labor market. Growth is definitely stronger than we thought, and inflation is coming a little higher. So the good news is that we can afford to be a little more cautious as we try to find neutral.
Mr. Powell also responded to concerns around the Fed's independence under the incoming Trump administration, saying the central bank's mandate is well supported.
We're supposed to achieve maximum employment and price stability for the benefit of all Americans and keep out of politics completely. I think there is very, very broad support for that set of ideas in Congress, in both political parties, on both sides of the hill. And that's what really matters. It's the law of the land. And I'm not concerned that there's some risk that we would lose our statutory independence.
Richmond Fed President Tom Barkin joined CNBC's CFO Council Summit and said he sees reasons to be cautious ahead of this month's meet.
I see positives on both sides, but I definitely see risks on both sides. On the inflation side, we talk about the progress, but we're still in the mid-twos, not at 2, and so we're still above our target. That's a risk. On the employment side, you can't ignore last month's jobs report, even if you try to explain it away. 12,000 jobs is not good. We'll get another jobs report on Friday. And, there is risk when hiring's down in this country that eventually job growth starts to slow.
You can explain it away, can't you? Didn't we have enormous strikes on the Northwest? And we also had port issues. We had and some devastating storms. Anyway, not for me to argue, for once. Citadel CEO Ken Griffin also weighed in on policy making at the Fed, accusing the Biden administration of making Chair Jerome Powell's job more difficult in recent years.
Powell's had one of the worst jobs you could have because the Biden administration, in their reckless fiscal spending, put this country on an inflationary path that was unprecedented in our lifetime. And he's had to deal with cleaning up the mess of that fiscal largesse, just as this administration is going to have to clean up that mess. So he's had a really tough no-win job over the last few years.
Wasn't it the COVID crisis that put the inflation anyway, he blames Biden. There you go. We'll get the latest non-farm payrolls print out of the US tomorrow. The headline growth figure is projected to rise to 200,000, according to LSEG, after extreme weather events and strikes, as we mentioned, at Boeing hit October's print. George Lagarias, chief economist at Forvis Mazars, joins us now. Well, as hard as the job may have been, and we can argue about why it was so hard, the fact is they seem to have done something miraculous. And I say seem to have because not everything is as it seems always. i.e., they have got inflation down aggressively. All right, landing it bang on 2% is proving slightly problematic. But by and large, the US economy is growing pretty well. The unemployment picture is tame at the moment. Growth, unemployment, and indeed inflation all seem to be doing pretty well, aren't they?
So That's great, but growth is on the back of ballooning deficits, so that is an issue. Okay, that's not just growth that came from productivity. And also, yes, the inflation is down, but a lot of that has to do with China. China is coming off its real estate bubble. It's deflating the world because it has also a lot of spare capacity, like super overcapacity. Okay, and that allows it to deflate goods. So if you look at the inflation numbers, you have services inflation, which is roughly 2% above the average, and goods inflation, which is roughly 2% below the average. Okay, so it's China deflating the world. A lot of that disinflation doesn't have to do necessarily with the Fed's actions. It has a lot to do with China.
I'm just going to go back a little bit, if I may. Haven't we loved Chinese deflationary or disinflationary impetuses this entire century? Haven't we been joyous about it, that it's kept prices down?
For 25 years, that's been China's role to deflate the world, right? And yes, we do like it, but now that we have services inflation that much higher than average, we also rely on China to keep disinflating the world. And as you've noticed, China is trying to restart its economy. It's throwing trillions at the problem. And that means that producer prices could pick up. And that is the one single factor that could induce US inflation to pick up. Apart, let's take tariffs away from the discussion right now. All other things being equal.
So what will that do to the ebullient picture we are seeing in the United States with the dollar maintaining strength that many people hadn't expected, with the Treasury yields a lot lower than many people have feared, given the ballooning deficits that you and the CBO and the IIF and others have been flagging to us as well? What's it going to do to the ability of the administration and the Fed going forward, whoever is going to be its chair after the term of Powell as well, to negotiate all this?
Well, look, again, let's just take tariffs out of the equation because that's a huge disruptor, and let's look at the economy where it is right now. If China picks up, inflation picks up. If inflation picks up, and services inflation hasn't come down quickly, you saw the jobs numbers, you saw the wages numbers. Okay, so services inflation is persistent. If that hasn't happened, then inflation picks up. That means interest rates stay close to where they are. We're not heading towards that neutral interest rate, which could be at around 2.5%.
Do you want to make a call on the dollar, or any of the pairs, or anything for 2025? Are you doing all that stuff at the moment?
I'm the worst person to call on currencies. Currencies are unpredictable.
It's a pretty good competition for being the worst person.
So no, but look, and the point is also there are potential tariffs coming up, and that could create havoc in the FX market.
Oh, so where's the safe haven? Not the Swissy, is it? As usual.
Well, why not?
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.